Where should beginners keep their money before investing? Most beginners do not lose money because they invest badly. They lose money because they invest too soon. And this is where a lot of new investors misunderstand the process. They believe the moment they earn extra income, whether from AI tools, side projects, or freelancing, that the next logical step is immediately putting that money into the stock market. But investing is not the first step. Stability is. Before you invest, you need a structure. And today, I want to walk you through a simple 3-layer framework that helps beginners build that structure the right way. If you watched the previous video, we talked about what to do with your first AI income and how to begin thinking about long-term investing. But before consistent investing becomes your focus, you need to make sure your foundation is strong, because investing without stability creates stress. And stressed investors make poor decisions. Let's break this down clearly. There are 3 financial layers every beginner should understand. Layer 1 is stability. Layer 2 is liquidity. Layer 3 is growth. Most people jump straight to layer 3. That is the mistake. Layer 1, stability. Stability means protection. It means having enough accessible cash to handle unexpected events without touching investments. For most beginners, this means building an emergency fund. The typical guideline is 3 to 6 months of essential expenses, not luxury spending, just essential expenses. If your essential monthly expenses are $2,000, your stability target is $6,000 to $12,000. That may sound like a large number, but this is not built overnight. It is built consistently. And this is where your AI income can begin serving a purpose. Instead of investing immediately, your first goal may simply be to build this stability layer. Now, where should that money actually sit? Not under a mattress, not in a regular checking account earning nothing. This is where beginner-friendly institutions come into play. High-yield savings accounts at banks like Ally or Marcus are common starting points. Brokerage firms like Fidelity, Vanguard, and Charles Schwab also offer money market accounts that pay competitive interest while keeping funds accessible. These accounts are not designed for growth. They are designed for safety and accessibility. That is the point. Layer 2, liquidity. Liquidity is different from stability. Liquidity means flexibility. This is money that is not part of your emergency fund, but still not long-term invested capital. For example, you may have extra cash saved beyond your emergency fund. You may be preparing for a large purchase within 1 to 3 years. You may want capital available for opportunities. Liquidity funds can sit in high-yield savings accounts, money market funds, short-term Treasury bills. Treasury bills, often purchased through platforms like Treasury Direct or brokerage accounts such as Fidelity, are backed by the U.S. government and commonly used by conservative investors seeking short-term yield. Again, this is not about maximizing returns. It is about flexibility and capital preservation. Layer 3, growth. Only after stability and liquidity are addressed does growth become the priority. This is where long-term investing begins. Index funds, broad market, ETFs, long-term retirement accounts. But growth only works well when the first 2 layers are secure. Because if an emergency happens and you have no stability layer, you will be forced to sell investments at the wrong time. That is how beginners lose confidence, not because markets fluctuate, but because they were unprepared. Let's walk through a simple scenario. Imagine you have earned $1,000 from AI projects over several months. You also decide to invest $75 per month consistently. Now imagine your car needs an unexpected $1,000 repair. If that money was immediately invested into the market, you might be forced to sell during a downturn. But if that $1,000 was sitting in a high-yield savings account as part of your stability layer, you simply pay the repair and move forward. No stress, no panic, no disruption to your investment strategy. That is the power of structure. So how do you know when you are actually ready to invest aggressively? Here are 4 signals. You have at least 3 months of essential expenses saved. You have no high-interest consumer debt. Your income is stable and predictable. You are investing with a 5-year or longer time horizon. If those conditions are met, investing becomes logical. If they are not, focus on layer 1 and layer 2 first. Notice what we did not talk about today. We did not talk about picking stocks. We did not talk about chasing returns. We did not talk about timing the market. Because real wealth is not built by jumping into growth first. It is built by constructing a stable base. This is how I think about modern wealth building. Income is important, but structure determines longevity. And when your structure is strong, investing becomes calm. Not emotional, not reactive, not rushed. In the next video, we will take this one step further and walk through how to build a simple monthly wealth system that integrates income, stability, liquidity, and growth into one repeatable process. If you are building income and thinking long-term, subscribe to follow the framework here on Van Fox. Because building wealth is not about speed. It is about system.